Welcome to Invested in Climate. Protecting the planet and decarbonizing the global economy is the challenge of our time. We all have a role to play, and the opportunity we face is unprecedented. Invested in Climate aims to help people do more to address climate change through their work, investments, lifestyle, and activism. I'm your host, Jason Rissman. I support a growing community of top climate and ESG leaders as the Chief Experience Officer at NationsWell, and I'm an advisor to the climate practice at IDEO. I'm also an investor and startup advisor, and when it comes to climate action, I know I'll be a lifelong learner, always looking to have more impact. If you like what you hear, give us a good rating on Apple, Spotify, or wherever you found us. Sign up for updates and suggest ideas for future episodes at investedinclimate.com. Follow us on social, subscribe, and spread the word. Thanks for joining.
Our commitment to only invest in technologies that have the potential to reduce at least 2.5 gigatons of greenhouse gases between now and 2050 was something that I really wanted to commit the rest of my working life to and be on a team in a company with others that were as equally committed. So I think what really makes us different is that we are very committed to the decarbonization of the global economy. It's an investment criteria for us. We won't invest in companies that we don't believe can get that scale.
Hey everyone, we know we need to be investing trillions of dollars annually into the climate transition. Venture capital is just a small slice of the pie, but there's simply no time to slow down its contribution to advancing climate solutions. In 2023, however, climate tech venture funding dropped 30% to $32 billion. Whether this was a temporary slowdown caused by high interest rates in the macro environment or the new normal will make a big difference. Recently, I've been thrilled to start hearing about funds that are closing new and significantly bigger rounds. One such firm is Clean Energy Ventures. They just raised their second fund, which is 3 times the size of their first, and I was pleased to get to hear the details from Clean Energy Ventures co-founder and managing partner, Fennell. Temple's been investing in climate tech since 2017, and he has held fast to focusing on companies that can reduce emissions by multiple gigatons. In today's conversation, we hear how Temple got started in climate tech investing and what he seeks in an investment. We hear about some of his portfolio companies, the changes he sees in climate investing, and much more. Lots to learn in this one. Enjoy. Hello, Temple. Welcome to Invested in Climate. So great to meet you and have you here today.
Jason, thank you. It's an honor to be here. I've really enjoyed your work to date. You've spoken to many of my friends and many of my peers. Honored to be included amongst them.
Well, fantastic. Looking forward to today's conversation. And first off, congratulations on closing your second fund. We'll definitely want to hear about that raise. But first, let's hear a bit about you. You co-founded Clean Energy Ventures 6.5 years ago. You've directed a Harvard program on impact investing. But before that, you were a founder and CEO in film and media. So tell us a bit about your path and how you decided to focus on climate investing.
Yeah, happy to. I actually started off as an engineer, systems engineer, and created a couple of technology businesses in the 90s that were internet technology businesses. One was built around a patent that I created with a few others. And we were funded by the usual suspects of VCs back in the day. In the 2000s, I joined a group of media companies that were a very successful group of bands, artist management, publishing rights. And I was the CEO of a company with 3 other partners that basically financed films. And similar to financing a windmill, when we have a film, we would put together a package. We would have offtake agreements. We would pre-sell rights to the film to distributors around the world. So putting together some fairly complex project finance and also really understanding all the pieces of the intercreditor agreements, completion bonds, things like that. And more than 20 years ago, I married into a family that's an oil and gas family. And so my wife's family was in exploration and production from Louisiana, Arkansas, Texas. Exploration and production, downstream gas stations. And her grandmother, who was one of the founders of these public companies, the family asked me to work with my brother-in-law and basically develop an investment strategy around clean tech and ag tech too, at a very large farm in 2007 that we were converting to all organic regenerative practices. So I rolled up my sleeve and started looking at clean tech and ag tech and spent a good bit of time looking at the VC space and some of the people that I knew from my previous life as an entrepreneur. But ultimately, I didn't really feel comfortable with that. Even though I had a technology background, I didn't really understand the hard tech that these guys were doing. What I did understand was the project finance around wind. One of our first investments was in a person who was actually the CFO of one of my companies, a man by the name of Sandy Reisky. And he created a company called Apex Clean Wind, which became the largest independent wind developer in the US. So we provided his initial capital with him. He co-invested with him and also invested in solar. I really understood that. And as I started moving upstream into really understanding the components that were behind these projects and these technologies, the more and more, it's one of those situations, the more you know, the more you realize you don't know. And I realized that I was moving into sort of the growth in midstream and into the venture, I really needed to take a pause and really go back to school. And that brought me to MIT. I applied to be a Sloan Fellow around 2012, 13, and came up to Cambridge and went very deep in the technology. And ultimately just realized I had to choose between ag tech and clean tech. I tell people, it amazes me to see funds that can actually invest in both. I couldn't. To me, it wasn't apples and oranges. It was like apples and selling Formula One tires. It's like completely different in every possible way, the difference in the ag inputs and the clean tech inputs. But so anyway, during that time, I kept hearing about this group called the Clean Energy Venture Group, which was really a private syndicate. We also, at that time, around 2012, created another syndicate of families that were really leading the way in investing in ag tech and clean tech. So if you look at the cap tables of ag tech and clean tech, they were mostly funded after the financial crisis by large families, the Walton family, Jeff Skoll, the Simon family, us and others. And we all came together, about 15 of us came together and created a syndicate called the Clean Renewable Environment Opportunities. That's what CREO stands for. Or at the time, Jeremy Grantham was also a big part of that. So I was really kind of between these two syndicates. One was asset owners that were very much committed to investing in these climate solutions, and this amazing collection of engineers and operators, people similar to myself, called the Clean Energy Venture Group. So it was natural to sort of bring the two together. The Clean Energy Venture Group had done extraordinarily well, and Dan and Dave had. And during that financial crisis, not only did their portfolio survive Clean Tech 1.0, it actually thrived. They had a very high IRR. They had a very nice DPI. What they didn't have is a lot of capital behind them. It was sort of a natural thing for me to do, is to bring the capital to the talent. And that's really what I did in 2017.
Well, thank you for that background, Temple. It sounds like really interesting, actually, that there are some real parallels between media and film financing and clean tech financing. And I'm sure you learned a lot in that process. Let's talk now about Clean Energy Ventures. Your first fund was a $110 million fund. Tell us about your investment thesis for the fund and what has made the firm unique.
What I think makes the firm unique, and really why I committed to really leaning in and helping build this fund with Dan and Dave, is the fact that it was a group of really engineers and operators like myself that had started and scaled businesses. They were absolutely committed to finding these brilliant entrepreneurs that had a technology that they had developed that was highly disruptive, oftentimes unprecedented technology. And the founders were brilliant at creating the commercial technology, but they've never actually created a commercially scalable business. And this group of people in this Clean Energy Venture Group, that's really what they had done for their entire careers. So we were very akin in spirits and strategy into how we wanted to spend our energy and our capital. The second piece was that they were also committed to decarbonization. We think a lot about the amount of carbon in the global economy that needs to be taken out in order to try to reach the 1.5 degrees goal that we're trying to hit, even though that's unlikely at this point. Even if all the Paris Agreement pledges were hit, it would only take out about 40% of the carbon that needs to be reduced from the global economy. Our commitment to only invest in technologies that have the potential to reduce at least 2.5 gigatons of greenhouse gases between now and 2050 was something that I really wanted to commit the rest of my working life to, and be on a team in a company with others that were as equally committed. So I think what really makes us different is that we are very committed to the decarbonization of the global economy. It's an investment criteria for us. We won't invest in companies that we don't believe can get that scale, but also how hands-on we are. We really jump in and build these businesses. We're often the largest investor. We're the lead investor. We lead the due diligence. We're sitting on the boards. We're introducing some of these founders to the first strategic investors and customers. We bring in leadership coaching, which is a really big part of even our assessment, is really understanding who these people are. And because many of us have been on the other side of the table as entrepreneurs, it started with nothing but an idea. We understand that journey, and we can hopefully really help these founders grow themselves as people as well as grow the business. And also, I think the third piece, which was really attractive to me, is more than 70, probably 80% of the companies have, 90% of the companies have strategic investors. I think there's 70 plus strategic co-investors on the cap tables. And so we work very closely with industry. And this co-investors, these strategics, are often bringing us deals. They're helping us understand exactly what the milestones the companies need to achieve in order to be attractive for an acquisition. We're very disciplined in our pricing. We start at the exit. I think one thing that a lot of people have a hard time accepting is the fact that exits to strategics are still tightly banded between 100 million and 300 million. When you're coming in at a seed stage, you really need to be underwriting that company for at least a 10x return. So if you're investing in a seed or even a Series A at $50 or $60 million pre, and that company needs another $150 million to scale, it's not likely you're going to get a decent return for your LPs at a $200 to $300 million exit. So we're very disciplined in that as well, and the group always has been.
That's great. Temple, I'm sure that in developing this first fund, you surely brought some expectations and assumptions with you. And I'm curious that over the years, what assumptions proved right? And what were also some surprises that you encountered?
Well, first of all, it was very lonely when we started in 2017. There were less than a dozen firms in the US and about 6 in Europe that you could count that were actually focused on early stage technologies. I would think the biggest surprise is the huge amount of capital that came in really starting around 2020 and 2021, which is great. And the field got very crowded. That was not something that we were expecting at all. It was also quite challenging for us as well, because as I was mentioning earlier, we have a very rigorous diligence process, and we were seeing deals going out raising money at a certain price and the deals getting actually bid up and the closing in 2 to 3 weeks, where when you're looking at unprecedented technology that could be first of a kind, it takes a minimum of 2 to 3 months just to really understand the technology. So we were really getting rushed in these deals, and we frankly just decided we're not going to break our rigor. We are going to continue to run our diligence process. So we watched a lot of deals go by us. I have to say, even though we were feeling a lot of FOMO at the time, a lot of those deals are coming back to us now, looking for capital, until we are looking at a number of them. I would also say what's really been surprising to me, and this goes back to 2007, as an oil and gas company, when we were looking at the 4 primary uses of fossil fuels, what fuel sectors that, such as long-haul trucking, shipping, airlines, very difficult to see how technology was going to displace fossil fuel-based oil or fuels. Also in feedstocks for petrochemicals, and you look at some of the large industrial processes like Haber-Bosch that you use to make ammonia, which is 80% of ammonia is used as nitrogen. Very difficult to see how that would ever be displaced, or steam methane reformation for creating hydrogen. But we have these incredible inventors, scientists, and engineers that have invented processes. We have a company called Nitrofix that completely displaces Haber-Bosch. And so they're actually able to use an electrolyzer to make the hydrogen, which is a green hydrogen, and take the atmospheric nitrogen and make an NH3 molecule. So it's an incredibly low cost, very modular way of making ammonia. And somebody told me that was possible 7 years ago, and I would say absolutely not. And so we're really, really excited by particularly the electrochemical processes that we're seeing and just the sheer brilliance of the innovation that's coming into the industry.
That's great. Well, I love the tangible examples. Let's stay tangible and talk about a couple of the companies that you've invested in. How about this? I'll pick a couple, and then if there's others that you want to bring up as well, I'll give you a chance also. Let's start with Rebound Technologies. They've developed a technology for frozen food processors and cold chain logistics companies. Tell us about the business potential you see, as well as how it will impact climate.
Yeah, absolutely. That's what I feel quite passionate about, What they're addressing is actually a very dangerous positive feedback loop that the world is in right now. As we know, we need refrigeration and cooling to keep people cool, to keep our food cool, now to keep our data cool, our medicine cool. Then the way we keep it cool is we run compressors. Compressors are in your refrigerator, they're in your air conditioner. Those compressors in many countries are being run off the grid or running off generators that are being powered by fossil fuel. In fact, the HVACR consumes about 10% of all electricity produced. So as the world gets hotter, we're burning more and more fossil fuels to stay cool, which is increasing the temperature, which causes us to burn more fossil fuels. What these guys have done is basically broken that thermodynamic cycle. So they are essentially storing electrons as ice. And those electrons can come from renewables. They can come from the grid in the evening when there's excess power on the grid. And they basically store that ice and they use it on demand. Their first and their largest company is a company called Lineage Logistics, which is the largest cold storage food house company in the world. They have more than 400 facilities in 15 different countries. They've launched a very successful commercial unit in Greeley, Colorado. It stores millions and millions of tons of food. And they're having to run these very large compressors typically. But with this ice point technology from Rebound, they're actually able to turn the compressors off from 2 o'clock in the afternoon to 7 o'clock in the evening. It's completely unprecedented. It takes all that load off the grid. That same technology can be used for data centers as AI drives the cooling needs through the roof, as well as food processing, district cooling. If you look in Texas now, and unfortunately this is probably going to be true in India, we're having to build massive people cooling centers, but we're running fossil fuel generators to keep those people cool.
So Temple, let me do a double click here because it's interesting that you've had to go really deep into understanding cold chain logistics and that whole value chain. It makes me curious. Do you then look for other companies that are adjacent opportunities? Does it make you interested in other opportunities that in some ways are related to Rebound, but take advantage of that expertise that you've developed in some other way?
We actually have another company called Industrial that is actually able to manage that equipment remotely. Lineage Logistics has been an early investor in Industrial, and they're running on hundreds of Lineage's facilities. So we're absolutely looking at the other components. And it's not like every one of our technology is going to, they're certainly leaders at the time that we invest. Will they remain leaders? We don't know. We're constantly looking out for other innovation.
Well, another company that caught my eye was Aqua Membranes. Tell us about them and why you invested.
Well, a similar thesis, in some ways, a global thesis as we have for Rebound and the need for the global population to stay cool. Aqua membrane is, if you look at the world population, about 40% are living in water-stressed environments. There's two problems that need to be solved. One is that large industrial processes, and these can be everything from Ambev and Coca-Cola on the beverage side to lithium mining on another side, and even semiconductor fabs like Micron Semiconductor and Intel. They use a massive amount of water, and they're typically renting that water. So they're pulling the water off the municipal water system. A lot of that water is often coming from our aquifers that are getting severely depleted. And then they're dumping that dirty water out. And sometimes there's a little bit of cleanup. The reality is we need to start, and these industrial processes need to start owning the water. They need to buy the water and they need to clean it up and recycle it. That has become an existential problem for some companies. When Taiwan had a massive drought a few years ago, they actually had to shut down the semiconductor fab plants because there wasn't enough water to deal with the population. So that's really critical. We also want to have a better, faster, cheaper way of desalinating water so we can try to replenish the aquifers as well as try to serve the population. What Aqua membrane is able to do is be able to make that cleanup much, much more energy efficient. The way we do it now is with a process called reverse osmosis. And reverse osmosis takes a huge amount of energy. In fact, if we decided we were going to desalinate all the water required to relieve the 40% of the global population that's water stressed, it would emit about as much energy as all of the US emits in a single year. It's a massive drain. And Aqua membrane has developed a way to make those filters much, much more efficient.
Great. Well, I know there are about 20 other companies or more that you've invested in. So surely you'd like to sing their praises as well.
Right.
Anyone else that you'd like to tell us about as great examples of what you're interested in?
Oh, yeah, man. That's hard, though, right? It's like, who's your favorite child? I mean, there's so many that are amazing. I was talking about energy dense fuels that are clean, particularly jet fuel. We have a company that we invested in the UK called OxyCU. When we're looking at that company, and we do this for a number of companies, we do this for a company called Noon, it's often the parameters whereby we will invest are often after sometimes a year or more of really deep technical analysis. And when we were looking at when we were looking at sustainable aviation fuels, and there are a number of them out there, a number of technologies, we said, okay, what of these technologies has the potential to actually compete with fossil fuel jet fuel? And that's called Jet A. And right now, the green fuel, the airlines are willing to pay 6, 8, sometimes 10 times the price they can get Jet A for, fossil fuel-based Jet A. And these guys actually have a line of sight with their catalytic electrochemical process. Again, another amazing invention. They take out one very energy intensive step called the water gas shift, the reverse water gas shift process, and have an ability to get very close to the price of Jet A. And that right now, even though the airlines are buying as much as sustainable aviation fuel they can get, it's still a diminished amount of their overall fuel cost. Once they start getting up to 5, 10, 20% of their fuel, then they're not going to be willing to pay that premium. They just can't afford to. We set a similar parameters around long duration storage. We believe that lithium ion is going to rule the day here, at least for 10 or more years, for really short duration, really kind of the under 10 hours. But when you start looking at real resiliency and the ability of renewables plus storage to replace baseload, and particularly coal baseload, they really needs to be at a lower cost than lithium ion batteries will likely ever get to. And so when we were looking for long duration storage, we had a few very strict parameters. One is that it had to be able to deliver a kilowatt for less than sort of 3 cents. So the idea is that an amortized coal power is delivered really around 5 cents a kilowatt hour. So storage and renewables need to be at that price as well. Renewables that even at sort of the most optimized, efficient level can maybe be around 2.5 cents. So the storage needs to be delivering at 2.5 cents as well. And so that was quite difficult for us to find that. But it's very useful for our team to set those strict criteria because they basically can glance at a company and know right away it's not going to be a fit for us. The other thing that we were strict about is this battery storage can't use critical minerals. We really are handcuffed and choked by China's control of these critical minerals. We just did not feel like a long-term sustainable solution was viable if it had long duration storage. It also had to be relatively simple. I mean, we've seen a lot, particularly in the flow battery space, these batteries that are operating at high temperatures or high pressures, and they're operating in remote situations. And if we really want to be able to power the emerging markets, then we need to have something that is simple to run and cheap to build.
Temple, I love the level of analysis and thoughtfulness behind your thesis. And as we mentioned before, you just raised your second fund. You grew from 110 million in the first fund to a second fund that's over 300 million. So a big congratulations and really exciting you get to put that money to work. Now I'm curious, has your focus changed at all this time around?
Well, our fundamental strategy has not. Basically investing in these technologies that can scale globally. So one of the things, I've been an LP in a number of funds, the 2.5 gigatons is not just a decarbonization goal or an impact metric. It actually determines financial returns too. So rather than having a correlation between impact and financial returns, in our case, there's actually direct causality. So we're continuing to scour for those types of technologies. There are technologies in sectors that we aren't getting involved in, and one of them is ag that I touched on at the beginning, as we do believe that tremendous ability for natural capital managing forests and ag can be, but it's really not in our swim lane, and we like to stay close to our swim lane. That being said, we're finding that there are new technologies we're seeing every day that can fit into our metric of 2.5 gigatons. So we're not going to venture away from that lane that we've been operating in. Where we are going to expand and why we expanded the pool of capital is we are opening offices in London, and we're going to be doing much more investing out of Europe. And Nitrofix is actually based in Tel Aviv. And so we plan to be really finding technologies in Tel Aviv and trying to bring them into the global markets as well. So those are sort of geographical expansion, but also stage expansion. One of the things that we've been focused on, and there's a great paper that was written by S2G that was about what's called the missing middle. And they were talking about how there's $200 billion that was put into clean energy transition, VC and PE. And the reality is, though, is 80 billion of that went to the early stage and 80 plus went to the growth stage, to the TPGs and the Bain Capitals and the KKRs of the world. There's a dearth of capital in that middle stage where there are companies that have been de-risked, their technology is proven, they have customer traction, they may actually even have revenue. They're producing a unit of product, like a piece of industrial equipment. And they're able to, with their merry band of team, produce 5 units a month. But the reality is there's actual demonstrable demand for 10,000 a month. And there are very few capital sources out there to actually help those companies that are beyond the early stage, before the big growth stage. There's very little capital to fund that growth. And so we want to make sure that we're sufficiently capitalized to provide that to our companies.
That's great. And I can rewind for a second, Temple, and double click on something that I think I understood, but let's go into it. I think that what you're saying is that the 2.5 gigaton metric for you is an indicator not just of the level of climate impact that makes the company interesting, but you said that there's causality in terms of its relationship to a financial return that works for your LPs and for the type of return that you need to deliver. Is that right? And I'd love to better understand that causality.
Yeah, sure. And thanks for double clicking on that, because that's a big part of what we do. So on our website is a publicly available tool. It's called the Simple Emission Reduction Calculator. And it was developed by Dave Miller, one of our partners, started the fund, and Chambor Gupta. And it's actually used by more than 1,000 companies and funds around the world. And basically what we do, going back to taking carbon out of the global economy, the way we measure this is we look at what, for every unit a product that this is sold, every widget, let's say, or every unit of service it's delivered, how much carbon does that particular product or unit of service mitigate, avoid, or reduce from the global economy? Once you understand that unit reduction in carbon, then you're basically looking at its ability to scale. Does it have an S-curve? And how high does the S-curve go? What level does it become asymptotic? That's where the financial part comes in. If we find it's a niche product or a niche global adoption, then we have to step away. So the idea is we're looking at market adoption cycles, market adoption challenges. We're looking at penetration. And then ultimately, what is the global growth between now and 2050 potential?
Let's talk a bit more about your recent raise. The venture market tightened up a great deal over the past couple of years, and that you were able to raise a new and significantly larger fund is a great sign, perhaps, that the market is improving. We'd love to hear about the process of raising capital today, particularly relative to when you raised the earlier fund.
It has changed dramatically. When we were out raising in really kind of 2016, in fact, I think it was us and another fund called Congruent and Prime, they had just begun about that time. The reality is there were very few LPs that were even looking at climate investment at all, and certainly no institutional investors. And institutional meaning pensions, endowments, insurance companies, some sovereign possibly. It was quite difficult, and most of the LP capital was really coming from family offices and strategic investors. And somebody actually said we were the first early stage clean tech focused fund in 2017 that had launched in 10 years that was had that explicit swim lane of addressing decarbonization. That's a sad statistics that there was such a dearth of institutional capital, and $110 million actually seemed like a lot of capital back then for a fund. It's certainly doesn't seem as much now. It was quite challenging. And honestly, the hardest part was really finding people that cared, finding people that really wanted to address the problem of climate change and decarbonization. Now, when we did find a strategic investor we had actually one pension fund that did invest in us, or trust, and foundations, it was actually quite easy to get them on board. I fundamentally have a belief when you are raising money or trying to sell anything. I even tell this to some not-for-profits I work with. The hardest part of your job is finding people that care about the problem that you're solving. And so a good bit of what I do is just reaching out and talking to people and saying, hey, do you care about climate change? Are you looking to devote capital with the purpose of addressing the decarbonization of the global economy? And on the institutional world, there's still not many. They'll at least have a conversation. We couldn't even really have conversations with asset owners. We did some research. I'm not going to throw anybody really under the bus, but there are 99 institutional investors that were part of these two well-known organizations that I won't name at the moment that were very committed publicly to climate change. And we looked at their portfolio. They manage about $4 trillion. They have about $700 billion dedicated to PE and VC. And this is 2017. Only 9 had made a single LP commitment to a climate-related fund in the last 7 years. And the total LP commitment was less than $100 million. Now that's changed dramatically. We're seeing, particularly on the pension side, we're seeing CalSTRS and CalPERS and a number of others really stepping up, which is fantastic. The endowments, particularly the university endowments, they're still lagging here in the US. In Europe, it's quite different. Many of the pension funds and many of the endowments are really leading in.
Really interesting. I've heard that concern too about institutional investors and particularly endowments not having the risk tolerance to invest in the energy transition. But really interesting to hear your observations. Now, I'm curious about this particular moment. There have been many factors accelerating investment in climate, and over the last couple of years, factors that have been slowing it down. Obviously, there's much more activity than when you were first getting started, but compared to, say, the last couple of years, is the capital market for climate heating up and returning to what we saw in 2020 and 2021?
I don't really know, honestly. I do know a number of funds that are trying to raise now, and they are struggling. The reality is there are a lot of new funds in the market, and they're in their early cycle of developing a track record. And I think that a lot of these companies are really waiting for what's called DPI, distributed paid in capital, which is simply the amount of money they've given to the fund managers, how much of that money has been given back. Have they gotten 100% back? Have they gotten 200% back? And the reality is the fund managers that they've funded, they've just really only been investing in the last 3 or 4 years. These companies take 7 to 10 years to develop to get to a point of exit. So there's still a good bit of mileage to still cover here. The problem is too, in 2020 and 2021, as I mentioned earlier, the prices went up considerably at levels that we thought were really just not rational given the economics of the exit values. Now, those exit values really have not improved yet, and that really needs to improve. And people ask me, well, why is that? There's so much being written about companies making these net zero commitments. And it's true. There are 4,000 companies that have made net zero SBTI commitments. SBT is science-based targets. So they can't just buy offsets for forests and whatnot. They have to actually have science-based targets.
Actually, SBTI changed the rules recently. So offsetting is now allowed as part of SBTI, which has been driving a lot of folks crazy and sort of having a flip-flop and change of guidepost. But still, SBTI is obviously still seen as a really credible certification of one's climate goals and is still in some ways held up as a gold standard.
Yes, I'm so disappointed by that decision that they made. I think many of us are. But I do still feel like they are the leader in this space. The problem is, though, their companies are not leading. There's certain sectors, oddly enough, that actually are actively decarbonizing and have decarbonization mandates. And they're ones you wouldn't expect. If you look at steel, if you look at mining, shipping, concrete, those industries are rapidly decarbonizing. But last summer, we did a deep dive on the SBTI companies, and we could not find a single public statement of any decarbonization mandate with any real goals where they were actually buying technology, where the pledges were made, but the commitment to actually buying the technologies and building them into their operations, they're completely silent on that. And people have asked me, like, why? And in a lot of cases, quite frankly, the CEOs, they know that they need to decarbonize, or the business needs to decarbonize, but they hope that the next guy is going to do it. They don't want to necessarily take the risk. And that's also true with the operations people. The operations people have been spending a career fine-tuning the operations. The last thing they want to do is bring in some fancy new clean tech technology. So they're hoping for the retirement and get the gold watch and let the next guy do it. So the commitment to actually buying these clean tech technology is really, really de minimis at this point. And in order for this industry to thrive, these SBTI companies need to buy these technologies to generate revenue for these companies so that the strategics can buy these companies at decent values so that the LPs can be paid back and invest in the next cycle of funds. So it all really, to me, goes back to the lack of really actually authentic decarbonization mandates.
Temple, how do we change that? What do you think needs to happen to get the CEOs or the CTOs or the executive teams or the boards of companies to make near-term commitments to the clean tech technologies that really will drive their decarbonization?
Yeah, another great question. It's sticks and carrots. Right now, there's really no downside for just doing business as usual. Certainly, there's noise around it. And I think certainly the oil companies are getting a lot of flack for it. But there are many other companies in sectors outside of that just, there's really not any scrutiny on what they're actually doing. And they need carrots. Unfortunately, we need regulation. Regulation needs to provide a stick as well, but regulation can also provide a carrot. IRA is great for building infrastructure. It's not as good for actually driving new clean technology. It's really a set of production. I'm a big fan of the IRA, but we need something similar for mobilizing the development and manufacturing of clean energy technologies. So, I don't know. I think what's going to happen, it's going to be really interesting to see what happens in Europe when they're basically ring fencing the EU economy with strict sustainability requirements, where in order to enter the EU economy, you're going to have to hit these metrics. At least that's what they claim. And I think that's going to be a big wake-up call for a lot of companies and sectors that can count on Europe being a major part of their market.
Thanks, Temple. I'm curious how you see climate tech investing changing over the next few years. Are investors acting differently than they did previously?
Well, they're definitely acting in a different way than they were in 2021. As I mentioned earlier, we lead or co-lead all of our deals and lead the diligence. We got bumped out of a number of syndicates because we weren't willing to pay the price. We needed a lot longer than the company was willing to give us and the other investors were willing to give us for diligence. That's changed. So our diligence cycles now are more rational and reasonable to actually run a proper process. And the prices have started to come down when you can actually look at what is the exit potential of this company given the current market dynamics. I do think there are lessons learned there, but we're in a down cycle right now. And the lessons, I would say a lot of the lessons haven't been learned yet. And we're learning lessons every day, even though we've been doing this for 15 years. I think there's still, unfortunately, a lot of learning to go for a large portion of the new VCs. I do think there is, at least we hear noise and we see other funds that are claiming to fill this missing middle that I was referring to earlier, why we raised so much more money for this fund, which would be great to see because a lot of these companies that are really promising technologies are languishing and even going bankrupt because there's just nobody to step up and help them commercialize. So I do think there are going to be some interesting capital choices around the commercialization of these technologies. That's pre-KKR, TPG, Bain, when they need $20, $30 million in revenue.
Temple, let's close out by hearing what other opportunities you're seeing. We've spoken a lot about what you're investing in and the market overall. I'm curious if there are other areas outside of your focus that you're also excited about. And another way to think of this is if you had the ability to be running multiple funds in parallel, what else would you be investing in?
Wow. I haven't really thought about that. I don't really have many moments outside of running the fund to think about that. I would say within our sector, it's what I was just referring to, which was the missing middle piece, which is essential and exciting. And I think it's going to be a really important piece. There are lots of areas, though, that I think are huge opportunities. One area that I had to abandon that I was looking at when I moved away from ag and food is really figuring out how do we, and this is a behavioral change too, it's not just a technology change, but how do we shift the production of food to animal protein. It's been unfortunate that plant-based proteins really haven't worked, but whether it's the lab-based cell meat, whether that's going to actually be economical at some point, but there are things like shrimp and fish and other aquatics. It's not necessarily a primary protein source in the US diet, but certainly in the global diet it is. But we need to create much, much cleaner ways of growing that food indoors and doing it in a very economical way. To use a massive amount of land and the huge carbon footprint of growing our protein on land is just not sustainable. So I think a lot about that.
Temple, thank you so much. Best of luck with all that you're doing and with the new fund.
Thank you. It's great speaking with you, Jason.
Thanks for joining us for this episode of Invested in Climate. Please remember to rate us on Apple, Spotify, or Google. Find show notes, sign up for updates, get in touch, and visualize your climate action at investedinclimate.com. This podcast is for informational and entertainment purposes only and does not constitute financial, accounting, or legal advice. Thanks again.